Joining us now is David Rosenberg, president and founder of Rosenberg Research. David, it's great to have you on the show. I do want to get your thoughts about what we've seen here in equities and your expectation, not only through the rest of the year, where I know we have technicals and seasonals at play, but as you look to 2024.
Right. Well, look, today's reaction both in the stock market and the bond market, and of course the bond market led the stock market, you could argue is perfectly rational trading reaction to today's number. And it was a great number. I mean, you strip out rents, and the CPI was actually negative 0.1, and the year-over-year went from 2 to 1.5. So you do have to start to wonder at what point the Fed runs out of excuses to sound so hawkish. As far as the overall outlook, it really comes down to arithmetic. And I'm always guided by relative valuations. And in this case, I'm talking about the equity risk premium, which is still very thin. It's 95 basis points. And of course, what we're talking about here is the earnings yields that the S&P 500 delivers against the yield in the 10-year Treasury note. And historically, that gap is 300 basis points. Historically, you should be getting paid to take on the risk to be an equity investor. And to this day, and even after today's impressive rally, you're still paying to take on the risk. And that doesn't make a whole lot of sense to me. So this is still a 2 standard deviation event in terms of how stocks are trading relative to bonds. And so for next year, I think that we're going to see a pivot where for the first time in several years, Treasury market returns are going to outperform equity market returns. That if you think that the stock market is where it should be right now, to make it make sense from a yield perspective, and mean reverting to the historical average, the 10-year note would have to collapse to 1.5%. So everything I'm looking at, the homeowner affordability ratio, that's a mean reverting ratio. That has to include lower interest rates in the coming year. Mean reverting the equity risk premium, that has to include lower interest rates in the coming year. So my thematic for 2024 is that all roads lead to lower bond yields. And given the convexity at the long end of the curve, I agreed with your previous guest that I think that the long bond is going to be the place that you want to have money in for the next 12 months. I think they will deliver double-digit returns. Well, I think that what they want to see, and it actually is something that we did see in the last employment report, is slack coming to the fore in the labor market. They will be convinced once they see that wages are moderating and moderating for good. And I think that piece of the puzzle was solved. I guess you could always say, well, it's 1 month, but it's not 1 month. We're seeing actually a multi-month trend here of slower growth in wages and slower growth in prices. But I think that the Fed really wants to see the unemployment rate, move discernibly above 4%. And I think that at the same time, we start to see job losses. And look, nobody talks about the fact that the household survey, which is the companion survey you want to pay attention to at turning points in the cycle in both directions. The household survey actually showed in October that the economy lost 328,000 jobs. But of course, we bow down to the holy grail of nonfarm payrolls, which showed 150,000. You can only imagine what interest rates are going to be doing and what the Fed will be doing, which is like scrambling and seeing like a canary. If we start to see the payroll numbers start to look like the latest household numbers on the employment side. And I actually think that'll be coming by the early months of next year.